Hi Shilpa, good morning. Praneeth here.
On the topic, the future of transpricing. Prior to joining BMR, now Deloitte, Suchint was with PwC and earlier with Arthur Andersen, where he worked on a variety of assignments involving uncertain tax positions, FIN 48, APAs, maps, and planning and documentation. Suchint is a regular contributor to international taxation and transpricing publications and presentations. He is a graduate in commerce and a qualified chartered accountant, cost accountant, and company secretary. He has completed an advanced management program at the IIM Bangalore in association with HEC Paris. Welcome, Suchint. The co-speaker of the day would be Praneeth Narahari. Praneeth is a deputy manager in transpricing in Deloitte, India. Praneeth has over 5 years of experience in corporate, international tax, and valuation matters. He's specialized in advising clients on transpricing planning, compliance, litigation defense, and dispute resolution, mainly handling clients in technology, financial services, and consumer industries. Praneeth is a regular contributor on international tax and transpricing articles. He's a graduate in commerce and a qualified chartered accountant, cost accountant. Praneeth has completed all 3 levels of Chartered Financial Analyst CFA program. He has recently earned Financial Modeling and Valuation Analyst certification. Welcome, Praneeth.
Thank you very much for your kind introduction to us.
Thank you. Thank you, Tom. Thank you, Abraham. Thank you, Shilpa.
So basically, we all understand transpricing mainly from a tax angle. It's only in India that transpricing is mainly handled by chartered accountants, but globally, transpricing is one aspect which is mostly handled by economists. And we all know that the importance of economy for valuation assignments. In India, we have almost by a transpricing history of almost 20-25 years, and a lot of learnings has gone into development of documentation, development of methodologies. All these things can be easily and used for valuation assignments. With this background, I hand over the floor to Suchint and Praneeth. Carry on, Suchint, Praneeth.
Thank you, Uttam. Thank you for that introduction. Before I let Suchin to explain the purpose and objective of this session, I'll quickly explain the structure of this session so that you'll get a flavor as to how we are taking the flow of this session. So first, we will introduce TP regulations by explaining the terminology that we are going to use in this session, like pricing, unslent pricing, associated enterprise, international transaction. And then we'll explain what is the fine line between transpricing and valuation. Then we'll give a flavor as to what are the transpricing methods which are prescribed in the TP regulations. So this is with an understanding that all of you might or might not have knowledge of TP methods. Then we will start linking what are the transpricing comparability companies and comparability factors that could be used in relative valuation and DCF approaches of valuation methods. So there are case studies on how to search for comparable companies in a transfer pricing context, and what are the key takeaways that we can take to valuation. And there is a tribunal case law that we are going to present in the end, where a valuation report was used in the documentation and few of the data points were disputed. In the end, Suchin will share what are the opportunities that valuers will have in transfer pricing context. So a few housekeeping things. After every topic, we will present an poll. We'll request all the attendees to answer that poll. And while you answer that poll, we'll take up Q&As for whatever topics we have completed. And if you're trying to connect the dots and gathering your thoughts, at the end of the session, we'll have a feedback session, or you can share your experiences. We'll be happy to hear out. So with that, I'll leave it open to Suchin to give an introduction and take up first couple of slides.
Yeah, thank you, Praneeth. Just to tell everybody on the call, whatever we say and do is in our personal capacity. So that's just to clear the air. With that, we'll begin. I think it's So, of course, first and foremost, an honor and a privilege to being in your midst. Admittedly, it is virtual, but that's the new normal. It just allows for a much larger canvas and a much larger stage in that process. Uh, I think it's just to set the context, it's useful for everyone who's here a lot more familiar with valuation than we are to bring about a degree of comfort around what we would be speaking about. And therefore, to begin with, maybe I'll start with taking a leaf out of the valuation book and then turning to transfer pricing. So when we deal with valuation, we ordinarily deal with the concept of determining a value or a price, as it were, for the transfer of property, whether that is intangible property, tangible property, or financial instruments, for example. And the idea is that we use certain approaches in order to determine the price. One could be the reference, which is the deal value. So the deal value could be, in a way, the basis for arriving at the value. Or otherwise, there could be approaches that are cost-based approaches, market-based approaches, or other forms of valuation or comparable-based approaches. And the idea is that you adopt a certain methodology that, in effect, represents what fits the circumstances and facts of the case the best. And therefore, you could have, for instance, a relief from royalty, which applies typically to intangibles. You could have, for instance, a market multiple method that applies to any forms of securities, or you may have a discounted cash flow that is often used for, let's say, any transfer of business or intangibles, that where the level of ability to compare it with other market multiples or other market uh, comparables, as it were, is much weaker, and therefore the need to fall back on something that one has to assess at an internal management level, which is through predicted cash flows, and then discount those cash flows back, which of course at some point we will see involves some degree of elements of comparability, but at the core is essentially a projection of what the business knows best. Now that's how we approach uh, valuation. What we do in transfer pricing at the outset is that it is, if you think of a Venn diagram and you think of what everything that is encompassed in valuation, and you think of transfer pricing, then the intersection of then transfer pricing and valuation sit at some kind of an intersection. So there is a certain realm of transfer pricing that's out of that. So there's a circle of transfer pricing. There's a circle of valuation, and these two intersect. Now, where do they intersect? They intersect, first of all, when you deal with valuation, you could be dealing with valuation of property or typically assets between related parties or unrelated parties. So if you think of what valuation, the scope of valuation is, it is property or businesses or tangibles or intangibles or instruments between related and unrelated parties. When you think of transfer pricing, it is the price of anything. And when I say anything, it is the price of the commodity, the price of a number of units of production. It could be the price of any intangible. It could be the price of a tangible. It could be the price of a business. It could be the price of a of financial instruments. It could be the price of loans and guarantees. So it could be any price. So if you think of transfer pricing, it is a larger scope than valuation, because valuation refers to typically assets or businesses, whereas the notion of transfer pricing applies to anything that is that results in, let's call it, a gain or a loss. However, it is between related parties. So valuation can be between related parties and unrelated parties. Transfer pricing is between related parties. Valuation is about typically property. Transfer pricing is about everything including property. So therefore, there is a fine intersection between valuation and transfer pricing. And we will, in the course of this discussion, talk about both the intersection of transfer pricing and valuation, and we will also speak about transfer pricing in isolation, the principles of which to some extent could be borrowed for the purposes of valuation. Now, with that background, we'll turn to the next slide, which deals with the concepts of transfer pricing. And like Praneeth said, we'll take questions as we go along. We have many multiple choice questions interspersed, and that's where we will have an opportunity to bubble questions from the group. So when we deal with transfer pricing, we've got to first, as we said at the outset, transfer pricing is a subject that deals with associated enterprises and international transactions. Now, why associated enterprises? Because when you do not have associated enterprises, whatever you deal with is in fact the real value. That's what two unrelated parties would deal with in any circumstance as long as they were willing buyer and willing seller. And therefore, there is no question of determining a price or a value, as it were, in an open market transaction, because that already is a reference price. And therefore, often a role of a valuer comes up to back up a deal price. However, when we come to transfer pricing, we are dealing with the realm of associated enterprises, which means that these there's a let's imagine that there's a multinational group. That multinational group has a number of related parties. And why do these related parties exist? Because as you would appreciate, 60% of the world's transactions happen between companies of multinational groups. So world trade and commerce is largely orchestrated by the realm of associated enterprises and international transactions, which is smaller transactions. Right. May I suggest if we can mute the participants? All right, thank you. We can unmute as and when there's a question. So that's to do with the concept of associated enterprises, which is that because of the fact that there is commonality of control, capital, or management, these enterprises are linked somehow, and therefore transactions between them are orchestrated or can be orchestrated by virtue of the commonality of capital, control, management. For example, if a company holds more than 51% in another company, then the affairs of that subsidiary company can be influenced by the parent company. Similarly, if there are two companies that, for instance, are related because they are held by a common management. So think of, for instance, a trust or a fund that holds two companies, while it is by corporate form a trust or a fund which does not directly hold shares as by virtue of being subsidiaries, but at the same time the governing board of the trust or the fund is in effect making decisions on that could influence the affairs of these two companies that are the downstream investments. So therefore, the relationship between companies is affected or potentially affected by virtue of commonality of control, management, and capital. And therefore, the presumption is that the dealings of these companies or the transactions between associated enterprises need to be as if they were between unassociated enterprises or enterprises that are not associated. Now, what are these dealings? These dealings are any form of transaction. So if you go back to the basics of transfer pricing, we say anything that involves profit, income, loss, or assets that has a bearing on profit, income, loss, or assets is a transaction. And therefore, there are a whole gamut of transactions. They include intangibles, tangibles, financial instruments, anything to do with raw materials, finished goods, services, distribution, of course, trading, and all forms of restructuring that may happen are all forms of international transactions. And therefore, Whether you have a slump sale, you may have a business transfer, you may have the transfer of entire lines of manufacture. So you have, let's say, a line that manufactures cars and is a production line that is transferred. You may have just, if you're producing, if you're a bakery and you're producing bread, and each of these items of bread is the subject of transfer. Could apply to consumer products like soaps. It could apply to any forms of capital equipment, or consumer products, or pharmaceuticals. So you name it, and all of anything and everything that ultimately involves transactions having a bearing on profit, income, loss, or assets, whether or with or without consideration, will result in a transaction, and a transaction that happens between two associated enterprises having a cross-border impact is referred to as an international transaction. There is also a concept of a deemed international transaction, which is to say where a transaction that happens between two independent parties but is orchestrated by an associated enterprise is also regarded as being an international transaction. Now, that really gives us the context or sets the stage for what happens in the transfer pricing realm. And therefore, what transfer price seeks to do is that it determines the price between two associated enterprises that transact in an international transaction. Now, that is referred to as the transfer price. Now, that is our reference price. What we then seek to do is to determine how does that reference price compare with what is referred to in international parlance as the arm's length price. And the arm's length price is the price at which two parties that are unrelated and therefore have no conflict of interest would deal with each other. And therefore, when you think of what this is seeking to do, it is seeking to say that the buyer and the seller, in this case, the two related parties, have a set of alternatives available to them. And just like in a context of a perfect competitive market where you have demand and supply, there is a buyer who is able to look at multiple options to buy a product. So there is the reference transaction, which is the associated enterprise from which it could buy the commodity or buy the product. And there are other alternative sellers from which this associated enterprise could buy. Similarly, from the seller's perspective, there is one buyer, which is the associated enterprise, and there are other reference or other comparable buyers in the market to which this company, which is the selling company, can potentially sell. So what you are seeking to do is to establish a price between the two associated enterprises, having regard to willing buyers and willing sellers who may really or hypothetically exist in the open market. And that's why how those hypothetical buyers and sellers would transact, under what conditions, under what terms, is referred to as the arm's length price. And this is something that gets carried into cross-border tax treaties as well, to say that when you have a transaction that happens between two associated enterprises or two companies or two enterprises under the same management control capital, they have to deal with each other as if they were dealing with optionally available alternatives that they could have used almost as it were as an opportunity cost or an opportunity income. Why is arm's length price an essentiality? Arm's length price finds application in several regulations that are economic regulations that are to do with the ability to shift profits and result in unintended gains, but from an unintended gain that is detrimental or prejudicial to a government's revenue. So if you think of the exchange control regulations, they're seeking to protect the foreign exchange reserves of the country. They do not want to have a situation where you're shifting out uh, a certain component of foreign exchange which is excessive relative to what you are getting. Similarly, if you think of the Companies Act, again, the interests of the shareholders need to be protected in order to ensure that related parties to the transaction do not, in effect, siphon away funds of a company under the guise of their transactions. Because of the fact that related parties have the ability, by virtue of the corporate construct, to be able to influence the manner in which the corporate behaves. And then there are regulations such as those prescribed under the Income Tax Act, which is specifically prescribed, and that contains an exhaustive code on transfer pricing, which again in turn relies on international guidelines that speaks of how you determine an arm's length price. And just as we spoke about how you would determine valuation using different methods, the notions of transfer pricing also is premised on a set of methods, and these methods are intended to uh, ultimately reflect the determination of an arm's length price, but using a certain either a hierarchy or a certain rationale of identifying the most appropriate method among the set of methods that are prescribed. Again, the methods are dependent on what is the nature of or what is called as characterization of the buyer, what is the characterization of the seller. Is, for instance, the buyer a distributor? Is the seller a producer? Or is the buyer a somebody who owns intellectual property? Those are considerations on the basis of which a price is determined using a certain set of methods that is prescribed. And then there is the aspect uh, of a business need that may arise, particularly in the context of, as we would have studied in the costing context, or as we would have experienced with interdepartmental transfers for the purpose of management accounting. So think of it like this: that I have a business that has two businesses. There's an agency business and there is a let's say a distribution business. I could buy and sell, or I could get an agency commission, and effectively my costs are split between these two businesses. The cost allocation is dependent on which business in effect provides results in a higher, let's call it gross margin, and therefore the determination of gross margin could uh, could could influence the manner in which I apportion my costs. So therefore there could be considerations that arise from business decision making that also influence transfer pricing, independent of the need for regulation. Of late, since about the last 5 years, the focus of transfer pricing has been shifted towards what is called as base erosion and profit shifting. And what base erosion and profit shifting initiatives seek to do is to try and establish that there is no what is called as double non-taxation. And how does double non-taxation happen? For instance, if you, let's say, transact at prices that leave monies in jurisdictions where there is no economic activity, that could result in a case of base erosion. So think of a seller, in other words, a producer, who is selling something at a cost plus, let's say, 25%. So production cost 100, I sell it at 125 to Bermuda. Bermuda, in turn, has a arrangement with, let's say, India. So the US is transferring a commodity to Bermuda at 125. Bermuda has an arrangement with India. India has found out a customer, and the Indian customer is willing to pay, for instance, 225. And so this product that is 125 is transferred to India at, let's say, 200. And in effect, 75 is parked in Bermuda for really nothing, because there is nobody in Bermuda. There are no people, there are no assets, there are no factors of production. And then it comes to India and then India incurs some local cost and then sells it on at 225. In effect, there is a large amount of profit in the system that is shifted away from either the economic factor of production or the economic market of consumption and into a low tax jurisdiction, which is the reason why transfer pricing could become abusive, and that's the reason why the concept of base erosion and profit shifting has acquired uh, considerable velocity. And therefore, it's related to valuation because just like we spoke of commodity being transferred out, you could very well have an intangible that is similarly squirreled away into a low tax jurisdiction. So with that, I will pause and we'll go into the next slide.
Thanks, Suchint. Thanks for introducing transfer pricing. I hope all the participants got some basic understanding of transfer pricing. Before taking up any questions at this juncture, we'll present the first poll question here. So I request all the participants to answer these poll questions. Hope you are able to see the first poll on the screen. I will read the question. For which of the following is transfer pricing is used for? A. Company law. B. Income tax. C. Competition commission. D. Exchange control. Since it's the first poll question, I will give you a small hint. There are more than one right answer. In the sense, there is only one wrong answer to this question. So we will give you 1.5 minutes to answer this poll question, and we will see the poll results.
As per
Meanwhile,
IBBI,
go ahead, Shilpa.
as per IBBI guidelines, people attending the webinar are expected to participate in the poll questions, and the entire poll report will be submitted to IBBI. So your credit hours could be at stake in case you are not participating in the poll.
Meanwhile, if any of the participants have any questions at this juncture, we'll be happy to take up.
Can you elaborate on these three terminologies: base zero, profit shifting, and yellow tax jurisdiction?
Yeah, to keep it short, because it's an ocean by itself. But the concept of base erosion means that you have a certain tax base of a country, and the tax base of a country is determined by what its factors of production are. For example, so you think of land, labor, capital, and you would expect to get a certain return on all these factors of production. Uh, the concept of base erosion is if the factors of production and the returns arising from those factors of production, if those returns are taken away unfairly or unjustly to another jurisdiction, then that refers to the concept of base erosion. Profit shifting is more in the context of where, for instance, I give you the example of where you would have, uh, let's say, the Bermuda entity selling to an Indian company and the Indian company selling to the end customer. And here, the factor of production doesn't exist in India, but there is potential for making profits in India. And that profit could have been, if you didn't have the Bermuda entity, you could potentially have had much larger profits in the US, much larger profits in India, because a lot of the appropriation towards what you would be able to realize in the market, because your end selling prices is 225, you produced it for 100 and let's say 100 or 100, a little over 100. Therefore, you have the system profit, which is effectively almost 125 that needs to be allocated ideally between the US and India. In the context of India, India only got 25. That's the concept of profit shifting. Shifting of profits that otherwise would have belonged to India going into a low tax jurisdiction. And a low tax jurisdiction is essentially understood as a jurisdiction that has a very low rate of tax. So if India, for instance, has a 25% rate of tax, a low tax jurisdiction would allow you to be able to earn either zero or very or income at a very low tax rate, 5%, 7%.
Hope that has answered your question, Nana Prasad. So here are the poll results. I think most of them have answered the given a correct answer. So we have the transfer pricing regulations laid down in income tax. However, the transfer pricing analysis or concepts are used in company law and exchange control while evaluating the related party transactions. So there is no reference or not much use in the competition commission. So let's move on to the next topic. So I'll let Suchin to explain what is the fine line between transfer pricing and valuation. While there is overlap, there are certain fine differences between both of them. Over to you, Suchin.
Yeah, thanks, Pranay. So to continue, we had already in some sense explained the concept of transfer pricing and valuation as being represented in a Venn diagram. And pricing, therefore, is seen as a continuum, as a flow. Why do I say a flow? Because think of an assembly line that manufactures cars. Each and every automobile represents a unit that is the subject of transfer pricing. And therefore, each unit is transfer priced, whether it's to do with items of food, whether it's to do with items of pharmaceuticals, whether it's to do with items of automobiles, items of machinery, or for that matter, even intangibles such as you transfer, let's say, download applications, you download content. All of this is the subject of transfer pricing. So it's a flow. So as you have, so think of the business of flow is really all about production and consumption. And as long as that production and consumption happens between related parties, that refers to transfer price, irrespective of whether it is a capital asset or it is a product or a unit of produce. Valuation, on the other hand, is in a way a terminal game. So if you think of transfer price or price as the concept of flow, valuation is the concept of terminality. Why do I say that? Because it refers to the sum total of value that is realized over a period of time, which represents the useful life of an intangible, an asset, or a financial instrument. And therefore, when you transfer something that is of value, such as, for instance, a share, it represents the discounted cash flows that will arise of dividends and the inherent intrinsic value of the company represented by that one unit of share over the life of the company. And so it in effect represents a terminal value or an end of life value that is of course discounted or arrived at in today's context. So therefore, flow in the case of transfer pricing, terminality in the case of valuation. That's how you would differentiate between price and value. And therefore the point that transfer pricing has far wider reach because it deals with both capital and revenue items, but it deals with only the spectrum of associated enterprises. Valuation, on the other hand, has a much wider scope because it dealings with everybody, third parties and related parties, but it's the ambit of transfer of valuation, sorry, is limited to the determination of assets and financial instruments, and assets include both tangible and intangible assets, as if they were the determination of their terminal values or their values as of today that represent the entire profits that would arise from that particular asset or intangible or financial instrument. And therefore, if you think of slump sales, for instance, which is the transfer of a business as a whole, including assets and liabilities, that's a good example that requires valuation. If you think of the transfer of a brand, so for instance, if you had the Foster's brand in the context of liquor that was transferred, you had, let's say, the Kingfisher brand that was transferred to Heineken, those are cases where it involves the transfer of a brand, and therefore there is a valuation attached to it, which represents really the life of the cash flows that will emanate from the uh, intangible or the tangible, but brought down to today's value. And therefore, in a sense, you could say valuation, as Praneeth has explained, has defined it to be the sum of prices less cost. And if you think of it, it's really the the, the super profit, as it were, or the entire profit that is represented through cash flows that is all brought down to today, and that represents valuation. So that's the difference between price, value, and transfer price and valuation.
Thank you, Suchin. So we'll move on to the next topic. So here I'll briefly explain various transpricing methods that are described under transpricing regulations, which can be used to arrive at a arm's length price. So like how we have various valuation methods in the valuation context, we have some 6 methods which are there in the TP context, which we can use to arrive at the arm's length price. So before that, I want to make an interesting statement that all of you will be able to appreciate. So both the transpricing methods and TP methods are common across the globe. So whichever country you go, wherever there is need for transpricing or valuation, we use the same set of methods or concepts. The nomenclature wise, they might slightly differ, but the approaches are the same. So typically these whatever transfer pricing concepts or methods that I am going to explain are same across the globe. So with that, let's get started. So in the next slide, I've presented the 6 transfer pricing methods which are prescribed under the TP regulations, which can be used to arrive at the arm's length price. Before that, let me explain you. So conceptually, so what is the objective of any using any TP method? It is to arrive at an arm's length price. So how can we do that? So there are 2 ways to do that. One is a direct approach, and the other is indirect approach. So in the direct approach, we will directly look for the comparable transactions or prices. In the indirect approach, we look for the profits or margins that are earned by the comparable companies who are transacting those related transactions, similar transactions. So this I can link to both the methods that we have in the relative valuation or market approach, which we call comparable transactions approach and comparable companies approach. So let me give a small example. So in this, you can see one diagram where related party A, which is manufacturing, say, a smartphone and selling to related party B for a price of 100. Now, since this is a transaction between 2 related parties, we have to evaluate this transfer price by comparing it with an arm's length price. So how can we do that? So as I said, in a direct approach, we can directly look for comparable prices of this sale of smartphone between 2 unrelated parties. Say if we do that analysis and arrive at 105 or 110, that becomes an arm's length price. So that's a direct way to approach it. So in the transpricing context, that we call a comparable uncontrolled price, that we'll touch upon in the next slide. So the other way to do that is, it's not always possible to get the comparable prices and comparable transaction for each and every transfer price. So what we do in that context is look for comparable companies. So in our example, we look for comparable companies which are into similar business, manufacturing of smartphones, and check the appropriate base. So in case of a traders, we check the gross margins, and in case of manufacturers, we can check the net margins. So and then compare to arrive at the arm's length profit or gross margin or net profit. Okay. So indirectly, we arrive at the arm's length profits, and we know the cost, which is the unrelated cost. So we add that profit to the cost to arrive at the arm's length price. So this is in a general sense as to what are the 2 concepts to arrive at the arm's length price for a given transfer price. So let's understand with a example as to what are the various transpricing methods. Okay. So one important point or that I want to mention here is, so both in valuation and transpricing, So it will be pertinent to understand the application of each and every method, because be it a transfer pricing report or a valuation report, so we evaluate all the methods and say whether this method is right or wrong. So few methods could have limitations. That's why we reject few methods, and few methods could be most appropriate. So we will select the best or the most appropriate method among the methods. And if there is more than one best method, we will use it as a supplementary or corroborative method. The other methods we will reject, say, giving the valid reasons or limitations. So that's why it's important to understand the application of each and every method. So I must say that for a given transaction, there is a possibility that we can apply each of these methods. And for few transactions, we might end up using only one method based on the facts or information available. So the first one, so let me just read out all the methods which are there. One is comparable uncontrolled price method. Second is resale price method. Third is cost plus method. Fourth is profit split method. Fifth is transactional net margin method. Sixth is other method. So the essence of all these methods is there in the name itself. I can call all these methods have relative valuation approaches, because transfer pricing in its sense is only about relative valuation, where we compare to comparable transactions or comparable companies. So there is nothing on intrinsic valuation basis. So that can be used in other method that we'll touch upon in the upcoming slides. So first one is the comparable uncontrolled prices method. So connecting to my earlier example where I said that there is a sale of smartphone transaction between two related parties. So we can directly check for the comparable uncontrolled prices, in the sense a transaction between two unrelated parties in the open market, and that could be the comparable uncontrolled price. So one important thing about cup method is it calls for a stricter comparability, in the sense it's more stringent when compared to other methods. So it requires product to product comparability instead of the function to function comparability. Like in case of profits based method, it's fine if we compare the overall function, in the sense a manufacturer of hardware products to manufacturer of hardware products. Unlike in cup method, which says that okay, you have to compare this particular product to other particular product in an unrelated circumstance. So that's about comparable uncontrolled price method. Second is the resale price method. So resale price method, as there in its name itself, it's used in case of a distributors or traders. Let me give an example, connecting to our sale of smartphone example. If we have a manufacturer related party in US which is selling the traded good to Indian related party, which is in turn reselling or distributing that product in India. Okay. Now the Indian related party, which is a trader or a distributor, it's not adding any value to that product. It's directly purchasing that product from the related party and selling to the customers in India. Now, since that transaction is being undertaken between two related parties, we have to evaluate whether it is at arm's length or not. Since we don't have any indirect costs, or whatever indirect costs are there or not show value adding, we compare the gross margin which is earned by this related party trader, and find the comparable companies which are doing similar business of trading or distribution of these hardware products, and arrive at arm's length gross margin. And then that is how we check the gross margin in a transfer pricing transaction to a gross margin in a comparable transaction. So starting from here, we will link to comparable companies. We have to search for comparable companies in all these methods starting here, and look for appropriate base to arrive at the arm's length price. Next is the cost plus method. So even here, let me give an example of a contract manufacturer in India, which is manufacturing the smartphone under the directions of, say, a US related party, which is the entrepreneur, which is in turn selling to or distributing to all the customers worldwide. In this method, the essence is to arrive or to have the details of the cost, which are the prime cost. Prime costs, in the sense, the cost which is incurred to manufacturing a product, which includes cost of labor and cost of material and other direct overheads. To that, we add arm's length markup, which again is arrived based on the comparable companies, the markup which is owned by comparable companies, which are unrelated parties which are doing a similar function. So that's how we add the markup to that prime cost to arrive at the arm's length price. So next is the profit split method. So this profit split method, I can say, is the complex of all the methods, because it's mostly used in the context of intangibles. Intangibles is always a gray area, be it transfer pricing or valuation. However, there is a lot of literature in transfer pricing that we'll share in the ensuing slides. So let me take an example of an IP, intangible, where there is an US entity which is a legal owner of IP and doing the function of IP maintenance and IP protection, being a legal owner. And we have an Indian entity which is doing the core development of that IP and doing the exploitation of IP. So there are two parties who are relatively contributing to that intangible, which requires a share of profits or losses for their relative contribution. So we split the group profits or losses between these contributing entities based on appropriate profit splitting factors. I will give a simple example. The profit splitting factor can be the R&D cost which is incurred by the Indian entity and US entity. So that's about splitting the profits and arriving at the arm's length price in the profit split context. The next method is the transactional net margin method. So net margin, in the sense, this can be used in case of manufacturers which incur both the direct costs and indirect costs for right from manufacturing the product to selling it to the ultimate consumers. Here, similar to how we arrive at a comparable set in cost plus method or resale price method, we also look for comparable set and look for their net margins or any other appropriate profit or basis to arrive at the arm's length price. So one thing about transactional net margin method is it doesn't need to have a stricter comparison, product to product or apple to apple comparison, as long as the economic activity or the function is more or less the same. Like we can compare a manufacturer of a notebook to manufacturer of a computer or any other hardware product, because the overall function remains the same. So we can select the comparable set based on that. That's about transactional net margin method. The last comes the other method. So both the Indian transfer pricing regulations and the international transfer pricing regulations, I can call it OECD guidelines, provides flexibility to use either valuation reports or open market quotes or standard rate cards to defend the arm's length price or to substantiate the arm's length price. So here is where we can see an opportunity for the valuers, where the reliance can be placed on valuation reports to evaluate the arm's length price for a given transfer price. So there is one slide deck in the end where we'll talk about that opportunity in detail. So this is these are very simple examples as to give you a flavor of all these methods. So as I told you, it's important to understand all these methods. In a transfer pricing report, we will start with all the methods and say why this method is used and why this method is rejected or accepted based on limitations or the advantages that this method has, and finally select the most appropriate method out of it. So that's about these TP methods. If you have any questions, we can take it up. Meanwhile, let me present the poll question. Next poll question.
Right. So can I ask a couple of application-oriented questions, Praneeth?
Yes, yes,
Um,
sure, Ram. Yeah.
Sure. Okay. So in relation to your slide, no, see, normally we find that many people will tend to use this transactional net margin method because I think that's comparatively an easier method for people to use, and most chartered accountants, for instance, will tend to use that, I believe. Now, as as a valuer, suppose we go into a company which has multi-country transactions. What is your prescription? What is your suggestion? Let me say, uh, should we follow our own approach and figure out what could potentially be the price, or should we follow what is being used by the chartered accountant? What do you suggest is the method which we should follow? Should we follow our own approach? Is what I'm asking.
So I'll give a simple example. Say if you're trying to value a software development services entity, okay, say a captive entity which is earning a cost plus markup. Okay, as you said, as soon as we see a markup or net margin, we directly jump onto transactional net margin method. and we arrive at a set of comparable companies, which could be the starting point for value. So we take the comparable sets that we use in transactional net margin method now for the private companies and arrive at the final public companies. So relax certain screenings or filters or add certain public companies and derive the value out of it. So that is how there is slight overlap in the way the values can approach. So whoever has some idea of the comparable set that are used in TP method, they use the same thing and go on to do either this relative valuation of market comparables approach or whatever. But to my knowledge or whatever, based on my experience, so the it's not about selecting the method which is commonly used, okay, whether it is TP or valuation. It's about selecting the method based on the facts of the case and the information availability, okay. And we have to start with all the methods. So even in TP, though everyone selects transactional net margin method, they have to give very prudent reasons or cogent reasons why they are not selecting the other methods. So we have been seeing in litigation where selection of method is one of the major dispute. So if the consultants or the chartered accountants select that transactional margin method is the correct method for a set of transactions, the revenue will say that no, the cup method, the other method, or whatever is the correct method. So in that scenario, it will be very pertinent to have documentation in place where we have evaluated all the methods, okay, where we have tried all the methods based on the facts and information available. So few of the methods we would get results, we would not get results at the first step only. Say we get the results for 2 3 methods, then we can use the best method of it and then use the other methods to supplement that arm's length price or corroborate it. Or if we get only one method, then we should have strong reasons for rejection of other method. So I would say we have to independently evaluate and not place much reliance on the precedents uh, which is there for each transaction. So that's why in this slide I've mentioned few transactions that are generally used for each of these methods. But however, I made a statement that for every transaction, all these methods can be used, provided we have information, just like in valuation. So if we have a software development services entity, we can use DCF. And if we have comparable transactions or precedent transactions where there was a transaction between target buyer and a bidder for that software development services entity, we take those list of transactions. Or if we have a public companies or software development services entities, we can take that. So cost method gets knocked out in the first instance because it's not generally used. I'll explain in the ensuing slides. So we can use more than one method in valuation context also, but we have to give reason or limitations as to why we are not selecting the other methods. Hope so I'll ask Suchin to add on to it if he has any comments.
No, I think I agree with what you said. I just have one additional perspective to offer, which is that we often don't pay as much attention to what are called as internal comparables. So think of a software development company that has two customers. One is a related party distributor, and one is a related, even unrelated party buyer. And if you had agreed, let's say, at a per diem rate for both of them, then the price at which you would offer the service to the unrelated party would directly become a comparable for the related party transaction. Even if you did not, if you found that one was a project price and therefore may not be comparable with an hourly price, you could very well determine the profitability arising from the unrelated customer and the profitability arising from the related customer, and determine if the related customer's profitability internal to your organization is acceptable relative to the price that you charge the unrelated party. So that is one common, uh, uh, let's call it fallacy, that we tend to overlook by directly going in and looking for comparables. And that's something that the OECD guidelines also speak of, which is look for internal comparables before looking for external ones.
Right. Thanks for that. Um,
I have one question. Am I audible? Subbaradu here.
Yes.
Yeah. See, under the income tax rules and act and all, can there be a situation where both transfer pricing and valuation methodologies both would become applicable? And if yes, can there be a situation where the transfer pricing method adopted yields one output and the valuation method yields a second output, and both are different from each other?
It is possible, especially when it concerns intangibles. It is possible, and we will look at such cases as we go along in the slides. But it is possible, and that is the reason why, fortunately, the Income Tax Act is flexible enough to what is called as allow for another method So the other method, which is the sixth method, is applicable when you want to determine a price that does not necessarily fit into any of the five methods, and therefore the valuation could be a useful fallback for that. And the other thing is that even in the context of valuation, we appreciate that one price is not necessarily the answer. It could well be a range, and it is possible that the application of more than one method for transfer pricing. So just let's imagine that we were to apply just hypothetically some kind of a comparable uncontrolled price or a derivation of the price, and then you have another method and you apply both these, and you can get two different outcomes. But that only means that that gives you the indicative range. It gives you a range within which you could transact and say that the price, as long as I transact within this range, I'm good because I've established two price points as opposed to one.
So, but my question was, is there any provision in the Income Tax Act? Say, for example, a lot of foreign companies setting up back office processing centers here, and a decade and a half.
I think we lost you in middle. We were not able to hear that question. Can you please repeat that question?
Focus there, or whatever they've done for compliance with the transfer pricing rules, review all of that from the.
So, Braidu, we lost you in between.
Maybe you can try typing out the question.
Yeah. Was I not audible?
In between, we were.
Okay. So let me repeat the question. Unfortunately, I'm actually out of station in Hyderabad, and my net was not working using my mobile hotspot. And in between, some of these call centers bugging me. So that tends to push the correct. Am I audible now? I hope I'm audible clearly.
Yeah,
carry on.
Yeah. So my question was that all along these foreign companies and the back offices looked at transfer pricing as the piece of legislation that must be complied with and looked at very closely. So does the emergence of the valuation regime bring in an additional additional data point that must be factored in and considered in addition to the transfer pricing regulations? That was the question.
I think it hinges on what is the difference between price or transfer pricing and valuation. I think for when we determine flow, and that is why I said there's a difference between flow and terminal or flow and capital. And what we are referring here when we look at, say, export of software development services is the export of services, which is a flow activity. It's a continuum. Today you'll export software, tomorrow you'll export software, day after tomorrow you'll export software. But if on the other hand you were saying, I develop a product and I transfer that product, I transfer the ownership and the rights associated with that product, then that's the transfer of an intangible, and that will require a valuation. So there is a difference between price, which is the cost plus type of approach that we adopt for captive development companies, and valuation, that is in the context of, let's say, the transfer of intangibles. And therefore it's not, so when I speak of the concept of transfer pricing for export of services, we will not have a requirement for valuation. However, when we speak of the transfer of a software product, we will have both transfer pricing applying and valuation applying.
So just to give you a context, Suchint, see, our issues which we would face at a time when we are trying to do a valuation is that if we how much is the profit which should typically be retained in a certain jurisdiction. Let's say America is front-ending the transaction, for example, and the back office is located in India. So some of the people typically take the approach, I will retain 10% in the US for marketing cost, etc. This is not based on any FAR analysis. It is just a general principle which some of them follow. And the transfer pricing chartered accountant in India will basically issue a TNNM report, which says that so much has to be in India, so much has to be in US, etc. Now, as a valuer, when we go in to value the enterprise, our issue is this right? How much should have been actually retained in the US? What is the value of the enterprise? What are the tax rates which should be applicable to the overall enterprise? These are the issues which come up in valuation. Okay, the tax rate which will apply for a particular transaction, the overall tax which applies to the company. Or so this is just to give you a sense of the applications which we face. The second part of it, let's say, would be when we look at the IP between different. See, initially, when you try to structure and set up an enterprise, you will try to move the IP into the right jurisdiction so that on a going forward basis, the taxation is kept at the minimal amount. Now, this initial transfer of the IP, however, is where the issue comes up as to what is the tax applicable, what is the tax amortization benefit, and so on. So as valuers, when we try to understand the structure and therefore what is the tax implications and what is the tax rate which applies, this is where transfer pricing becomes very important to us, right? Just to give you the context of why we look at it. Yeah.
No, fully appreciate. Can I do this? Can we? Can I cover a few slides because we will
Yes,
address your
please do.
but we will.
Please
But
do.
we
Yeah,
will
sure.
as we speak in the slides. So the next point is to do with the applicability of transfer pricing concepts. And I'll speak of a few and then Praneeth will cover the rest in subsequent slides. We've already spoken about the crux of TPN valuation. We know that two associated enterprises and a transaction. That's coming together of these three, the quote unquote buyer, seller, and transaction is the crux of valuation because we're looking for viable alternatives that will allow us, and these alternatives are called comparables. So the comparables will enable us to determine appropriate prices or transaction values. Now, transfer pricing and valuation are interconnected and in terms of the techniques because they involve a set of economic or art form. When I say art form, really means econometrics, it means business analysis, it means the outlook and the relevant industry in which we are operating, all of the macroeconomic factors, all of the key competitive advantages of the company, these are all aspects of valuation. And these are all aspects of the so-called art of valuation or pricing. And when it comes to the hard data that backs up a valuation, whether it's to do with statistical analysis, ratio analysis, the financial projections, the let's think of it like profitability, cash profitability, working capital levels. This is all to do with the science. So therefore, the fact that transfer pricing and valuation are both an art and a science. And what's important is that there are some key commonalities in transfer pricing that can easily apply to valuation. So one of the things, if you look at the elements of a transfer pricing study, is that it contains a industry overview. Why is the industry overview relevant? Because different industries behave differently during at different times, and I think there is no better explanation than the cyclical and counter-cyclical situation that we are going through currently, where the technology companies and the healthcare companies are doing extremely well, and a lot of other businesses are in deep trouble. So therefore, the notion, the industry analysis is an important aspect. Economic analysis is an important aspect because economic analysis allows us to say that what does the particular entity function as? Is it a distributor? Is it a trader? Is it, and there's a difference between somebody who's doing marketing and somebody who's doing wholesaling. Is it a manufacturer that owns the IP, or is it a manufacturer that has licensed the IP and is therefore having to pay a consideration for it. So therefore, the characterization of the entity, and then determining the most appropriate method is the method. The choice of method will be dependent on industry analysis, the economic conditions, the characterization of the company, the current state of the economy itself. So why do I say that? For instance, one of the things that came out just yesterday was some guidance that came from the OECD on the COVID impact. And it said, if you are not making profits at the net level, which a distributor might not these days, then look at the gross level profitability and therefore move from an TNMM to an RPM if called for. Because you will often enough find that you might make adequate gross margins, but the net margins may not be there because you've got overhead expenses and on a low sales base. So therefore, there are these elements of commonality in TP. I must make a mention here that in the context of economic analysis, particularly the COVID impact has been very pronounced, and we did come out with a publication just earlier this week, which is the COVID impact on transfer pricing. And we've dealt with the approaches that are to do with quarterly data analysis that will help to determine the pricing on a go-forward basis. Also, regression analysis, which enables you to predict the economic, the profitability of comparable companies on the basis of the GDP of the country and the comparable companies' historical profitability. So, if historically companies had been operating at, let's say, 7% profitability, but GDP was growing at, let's say, 5%, then what would happen in a situation when GDP declines by, let's say, 8%, and therefore what would happen to the profitability? And we'll share our report for the benefit of the group. But the point to make is that underpinning this is the economic analysis that supports the reason why evaluation can be very different in today's time than it could have been 1 year before, or hopefully 1 year after.
Thanks, Suchint. So let me present the next poll question. Meanwhile, if anyone has any questions, we can take it up. So few of the questions we'll be answering in due course, because in the subsequent slides, we have few slides where we are trying to link the transfer pricing comparability and how we can use those comparable companies and comparability factors in valuation context. So we'll park those questions for now. We'll wait for another 20 seconds before I close the poll. I request all the participants to mark this poll because the attendance will be sent based on this.
Yeah, I think we have the answers coming through. Seems like a lot of people agree that organization structure analysis doesn't form part of the evaluation of the transfer pricing exercise.
That's correct, Suchint. So the organizational structure analysis, in the sense to see the entire org chart, the shareholding in an M&E group, is done to see what are the associated enterprises or and common parlance related parties, and then to identify the related party transactions. So that requirement is not there in valuation because it applies to whether related parties or not. So with that, let me move on to the next topic. So as Abram sir was mentioning that you see a comparable set where TNNM approach will be used in case of back-end offices or captive entities in India. So we'll explain how the typical search process is carried out in a transfer pricing context to arrive at the set of comparable companies with the help of an example. So this is a case study of an Indian resident entity, which is a subsidiary of US entity, and rendering software development services to its US entrepreneur as a captive entity, and earning a markup of cost plus 15% for the services. Since this transaction of, I call it provision of software development services from Indian entity to its related US holding company is an international transaction, we have to evaluate the markup which is earned in a related party context by comparing it with a markup which is earned by comparable companies in uncontrolled situations. So there are these boxes. So all these boxes are a sequence of steps that we follow in the transfer pricing context. So we have to give a write-up of all these steps in the transfer pricing report, which is required by the regulations. So this applies even in a valuation report. If you are using comparable transactions or comparable companies approach, it's not enough if you just put the final set of comparable transactions or comparable companies in the report, whether as part of annexures or part of the report. We have to give a brief on the search process as to how you arrive at the final set of comparables, starting from entire population of all the companies in India, applying various set of screens, whether quantitative or qualitative, and then arriving at the final set of comparables. So that's why it's important to understand all the steps and accordingly provide a write-up of what we call it as a search process, whether it is in transfer pricing report or a valuation report. So one point I want to make is, if you're valuing any back office or any company which has a transfer pricing implications, as I said earlier, the comparable set, in case if any method is used which warrants a comparable set to be used, that comparable set can be a starting point for valuation. And then you can take that, you can relax certain screens or filters, or you can tweak that based on the valuation requirement, and then take it forward. So let me start with the steps that are involved in the search process for arriving at the final set of comparables. First thing is, we start with the selection of methods. As I told earlier, there are 6 methods and we have to select one of the most appropriate methods. I think we have already tried to understand each of the methods. In this context, since there is this net markup that has to be tested against comparables, we have selected transactional net margin method as most appropriate method, while giving cogent reasons for rejection of other methods. Second thing is, we have to select the party. So there are two related parties. So from India side, it's provision of services, while from US side, it is receipt of services for which it is making a payment to Indian entity. So we can test the markups which is earned by either Indian entity or US entity against the comparables in their jurisdiction or geography. While selection of the tested party, we do a detailed functional asset and risk analysis and select a party which is least complex and where we can find reasonable comparables to test the markups of that tested party. So here, since Indian entity is just a captive entity which is bearing minimal risk and minimal functions for rendering the software development services, whereas US is an entrepreneur which is doing a whole lot of functions. We are selecting Indian entity as tested party, and we will use the search process to find set of comparable companies in India. The third thing is, we have to select appropriate base, which we call as a profit level indicator in transfer pricing context to test. So here, the 15% is a markup which is earned on the operating cost. So it's operating profit by operating cost, which we are seeing in the tested in the related party context. So we compute that base or profit level indicator for the comparable companies and arrive at the arm's length or markup or operating profit on the operating cost of comparable companies. So here comes the next important steps, or which will be common for comparable transactions or comparable companies approach in valuation context. So it's about selecting the comparables, final set of comparables from entire population of data. In transfer pricing context, we have publicly available databases like Capitaline, ASTP, and Progress that are generally used. And in valuation, we use Capital IQ or Traxon, Bloomberg, and sometimes Capitaline is used for both valuation and transfer pricing search processes. So we use the database based on one important thing for us as consultants is about the pricing. Second is the quality of database for the based on our need or what comparables or transactions we are looking for. So we generally use Provis or Kaplan or STP in transfer pricing context. So now those databases we have, say 50,000 or 70,000 companies, which where all the annual reports and data will be fed into the system. Now we have to start refining that entire population of comparables. How we do that? So in our example, we have to select comparables which are into software development services. First thing is to select the industry classification and sub-industry classification. So industry classification, we can select software development services or IT services, both nomenclatures are interchangeably used. And then sub-industry, we can select design in software, development in software, testing in software, consultancy in software. So the idea is to select as many as closely related keywords, because at the first stage, if we have a broader set, then we can apply additional screens and make it more robust. So that's about selecting the keywords. So there'll be a lot of keywords, lot of fields which will be there in the databases. So we have to be aware of what keywords would be connected based on the discussion with the management, understanding the business profile of the company, product profile, and then select appropriate keywords. Next thing is the filters or the screens to eliminate the companies which are not closely comparable. So I'll split these filters into two things. One is quantitative filters, which are filters which are driven by the numbers or the data points. The other is the qualitative, which are driven by the write-up or content which is provided in either annual report or the website of the company or based on our discussions with the management. So on the quantitative filters, in our case study, these are the typical quantitative filters that we apply. So we apply the data availability filter is important because at the end of the day, if you don't have the financials for that current year or the last 3 years, there is no point in selecting that comparable. Second is the size or revenue filter. This is applied in valuation context also. We can't compare a very small company which is earning 1 CR to a company which is earning like say Infosys or whatever which is earning 3,000 crore, because those companies will have higher customer recall value, good brand, and also they'll enjoy premium pricing as well as economics of scale. Because of it, cost optimization could happen. The other filters are core services filter, in the sense if a company is deriving operating revenue through more than 2 3 sources, we make sure that the revenue from software development services is minimum 25%. That's about core operating services income filter. And the other is export filter. Since this current matrix of an Indian entity which is exporting services to US entity, we can see comparables in similar context which are exporting services to its customers abroad. And then that's why we apply export earnings filter, saying that the comparable companies have to earn minimum of 75% from export earnings. And the last filter, so I'm not saying that these are the exhaustive filters. There are many more filters we can apply. It's all about the intuition of the consultant, which is more appropriate or not, based on for what purpose we are doing this comparable search. The last important one is the related party transaction filter. So this we can, it's not at least to our knowledge, it's not applied mostly in valuation, but it has to be applied. So the reason is, if there are companies which are transacting predominantly with related parties, then all their prices are tainted. In the sense they are controlled, unlike a company which is operating independently. So we try and reject the companies which have 25% of related party transactions, in the sense to remove the companies whose profits or whatever other transactions or the management decisions are not tainted by the group companies. So it's about related party transactions filter. So these are quantitative screens. The other is qualitative screens. Okay. So we will have entire population of 50 70,000 companies. After applying this quantitative, say we arrive at 50 or 40 companies. So what we do is a qualitative analysis where we download the annual reports of these companies, whether from the databases or MCA site, or go to the website of the company. If it is a public company, we get the annual reports from there, and then read through the annual report and see the company business profile, product profile, The accounting policies have to be consistent between the tested party and comparable companies, and see if there are segments, say software development segment, marketing support services segment, or any other segment. We have to make sure that we take relevant segment. And if there are any abnormalities or sudden fluctuations and all, or extraordinary items, we have to see if it is because of regular business conditions or because of extraordinary circumstances, and accordingly accept or reject those companies. So this is how we apply quantitative and qualitative filters. So from that 50, 70 companies, we arrived at 100 by applying keywords and quantitative filters, and then we arrive at final set of say 10, 15 companies by applying qualitative filters. So for the final set of companies, we compute what we call PLI. The transfer pricing allows us to use last 3 years data. It's called use of multiple year data to arrive at arm's length price, so that if there are any corrections that has to happen over last 3 years will be happening, and then we'll get a reasonable arm's length price or the profit margins. And second thing is, it also allows us to use something called range concept. Okay, so these whatever guidelines that are there in transfer pricing can also be borrowed and used in valuation scenario. It's already used because so in transfer pricing, I'll say the comparable companies or transactions are more than 6, then it says that you use a percentile range starting from 35th percentile to 65th percentile. So any price which is falling in that range will be uh, uh, deemed or consumed to be at arm's length. The comparable companies are less than six, it says that you have to use arithmetic mean. Similarly, in valuation, while using comparable transactions or comparable companies, where we have to calculate where we get the multiples of various companies, we calculate the average. We also see the median. Okay, that goes into the sensitivity analysis, and we give a range or band, saying that this could be the range of fair market values. So, and then if the final set of comparables have any differences in terms of, earlier Suchin was explaining, say if there are working capital differences or capacity utilization differences or differences in the risks that are assumed by these parties. So here the tested party is a captive entity, irrespective of the market and business environment. It will be earning 15% for sure, whereas the independent entrepreneur companies, which are not assured a markup, they are prone to the unsystematic risk factors of the market. So they are bearing higher risk when compared to the tested party. So we have to adjust for those differences. So there are various statistical approaches where we can adjust for those differences. So this is the typical search process in the transfer pricing context. So, and as I told you earlier, it will be very important and it's a requirement under the regulations to provide the write-up starting from selection of methods till use of adjustments and presenting the final set of comparables in the transfer pricing report. I think we can borrow the same thing, and it will be helpful if we can provide the same in the valuation report as well, because in future, if that valuation report goes into litigation or whatever, they can see that okay, there was a set of steps or procedures followed in arriving at the final set of companies, and if the problem is on screens or filters that they have used, that can be looked into. So with this, I'll present the next poll question. So while we present it, we can take any questions that you have at this juncture. Let me present it and I'll take up any questions.
Yeah, I just wanted to add
Yes.
to what Praneeth
Go
said
ahead,
about the fact that why the whole sequence of steps is important is that if we were to cherry pick companies, if we were to just pick companies that we pick up off the wall, then there's no systematic search process that will establish that we were dispassionate about selecting companies that were high profit making and low profit making, and the determination of whether those companies have high profits or low profits or other attributes relating to profitability that has a determination on the transfer price should not impact the manner in which we arrive at those companies, because there should be a bias in the selection. what the systematic search process does, and this is why documentation is so vital, is to establish that you followed bona fide due diligence processes in order to arrive at the appropriate comparable companies. Now, there can be disagreements around which companies are comparable or not comparable, but it will not be the case that you did not look at the reasonable universe of companies that you could have looked at, and that the selection in itself inherently was biased.
Okay, let me ask you then a question, which is, suppose we have, let's say, an Indian subsidiary of a global entity, which is, let's say, again in software. Now, I know that we can always follow this approach of taking comparable companies, which are subsidiaries of MNC companies, and looking at comparable valuations, we can work out a comparable valuation, no issue. Okay, but what is important to do here, Suchint? Should we get that transfer pricing report, which they have got first and foremost, so that we can assess as to what is the nature of the transactions which they are having with our global entities before we do the valuation? The situation is that quite often we may not have sufficient information for us to do the valuation. We don't know how much money they are making overall, and we don't get access to their overseas entities, just the Indian entity. So what is the approach you suggest that we should take here?
The transfer pricing documentation is a very good starting point, because while you will have financial statements, but there is no, in a way, there is no substitute like the transfer pricing report for a few reasons. One is that the rules in the Income Tax Act mandate that you talk about industry analysis, economic analysis, group overview, and characterization. So you and functional analysis, which inherently gives you directly a great deal of basis to say, what do I understand about the company beyond its financials? The second thing is that the ability to identify comparable companies is at the first brush taken up from the valuation report, sorry, from the transfer pricing report, because it gives you the search process and the manner in which the elimination of companies happened, why certain companies were excluded, why certain companies were included. And then you could start with that set of companies that was included as being a ready reference, and then see if you wanted to expand that to include more companies. They may have been excluded for reasons like the fact that their functional profile was not entirely appropriate, or they for instance failed some filter like a export filter. But you might find that because you don't have adequate number of comparable companies that are listed, you might have to go into taking those that are not comparable from a transfer pricing point of view. But that's perfectly all right. I think what's relevant is that you start with this as your starting point, and then you expand from there on. And it's not just the documentation, but there's also a notion or a concept of master file. And the master file is another useful document that deals with the transactions of the group and as they relate to the company in India.
Mm-hmm. Yeah, that's good. So the master file, if now let's say as a valuer, we have asked for this information. I mean, I know it's a situation which you may or may not have faced, but let me just pose this question. We have asked for this information. We have asked them for the master file for transfer pricing, which gives us the sense as to what is the nature of the transaction between the group, and where is the profitability lying, what is the nature of the business which is being done by other entities in the group. But if we don't get that information, what do we do in our report?
So I would say that if you think of it in the order of priority, I think getting the transfer pricing documentation is an essential. And I say it's an essential because that's mandated by the law. There is no reason for the company to not give you the documentation. I mean, if there is reluctance, that's another matter. But by law, the company is required to maintain its documentation, and therefore you should ordinarily get access to it. Master file, I can understand there are some thresholds, and there may be reasons why the master file may not be available in certain situations. But but when we look at it from a bottom-up approach, the transfer pricing study is more relevant than the master file. And therefore, getting access to the transfer pricing study is perhaps about 80% of the work done, and the master file might add 20% value.
Okay, got it. And in our reports, we should try to stay away from exposing any proprietary information which they may have, right? I mean, so for instance, let's say that we are writing a valuation report and we are saying that we have valued it on a certain basis and there is a certain profit which is retained in the Indian entity. How much of this information is relevant to be put into a valuation report? If I don't know if you have the answer to it, but what do you think would be a good way to handle this? Is it relevant to put into the report or not?
So the good thing is that companies are required to maintain their transfer pricing studies, and those transfer pricing studies are, let's say, not they are privileged communication between the company and the tax department, but in effect they are documents that would anyway at some point in time have to be shared with the department. To that extent, I think using the transfer pricing study and incorporating portions of it into the evaluation report seems to be completely in order. Now, insofar as the master file is concerned, I can tell you by experience, a lot of master files are built using data of the company in the public domain, that is like SEC filings, 10K filings. And therefore, again, a lot of master file data is good, cogent, presentable information, but not a lot of it is proprietary information. So again, you could, depending on, for instance, data sources, you could be well entitled to use master file related information as well. So I would say that the ability to leverage on the transfer pricing study should be quite high, because that anyway will be presented to the tax department.
Okay, thank you.
So just to add on to that, whatever documentation which is prepared for compliance and litigation purpose can be used. So whatever documentation or transferring study which is prepared for internal business and decision making purpose. So in that context, some information could be proprietary, and because it's all for internal purpose. So once a document is used for compliance and litigation, in case if it is litigated, you see many of the methods, share values, or the profit margins coming out in the tribunal case laws, which are publicly available.
Got it.
So can I
Actually,
ask
one more question. So particularly along with the looking at the transfer pricing documentation that the company has prepared when it comes to valuing it, would one also make sense to take a look at the status of the assessment? Say, for example, the company might have compiled a lot of documentation to support that cost plus 15% is a fair, is an arm's length price. But if the tax department has actually not accepted that and has raised demand notices, then perhaps relying on the documentation, internal documentation that have been compiled might not make sense, right? Because we know that in any case, the department has not accepted it. So relying on any of the numbers that, or any of those data sources that have been created to support the company's view on transfer pricing margin, ALM margins, might actually only lead to more trouble. What do you think?
So let me try to answer that. What are the contents or data points that we are leveraging from transfer pricing report? So let's start one by one. One is a group overview, okay, which gives the business and product profile of the Indian entity and as well as group entities. So that will not change because it's a fact. So that we can borrow. Second thing is the industry analysis. So industry analysis, we borrow it from publicly available reports like IBF or whatever. So that will not change because it's all statistical and based on the economic environment. Third thing is the comparable set, which is arrived after selecting so many methods. So this comparable set is what is litigated in the by the tax authorities. They say that tax authorities
correct.
being pro revenue, they will always want to select comparables which are making higher margins. Whereas we as a consultant will be more pragmatic in our approach by selecting mix of comparables by applying set of screens that are applicable in that context. So as long as transfer pricing report is prepared based on as per the guidelines and regulations, we can use that. Just because the markup is litigated before the revenue authorities, we do not think that this comparable set is not robust. Okay, as long as comparable set is arrived based on some set of steps, as we discussed earlier, we can take that as a starting point. So other thing is, in transfer pricing report, the comparable set will have both private and public companies. Okay, so for
Yeah.
valuation purposes, we have to select only public companies, especially when you are doing the relative valuation approach that I was going to discuss in this slide. Because in these comparable companies under relative valuation, we need the share value details for arriving at the market cap or the debt details. So for calculating the multiples like EV to EBITDA or EV to sales or PE multiple, that will not be available in private company cases. So we can you can start with the comparable set which is there in the transfer pricing report as a starting point. Now for the private companies from that, and in transfer pricing report, stricter screenings could be there which will not be required for valuation purposes. So you relax those filters and you will expand that final set, and you can add some additional comparables. I don't say it will be cherry picking, because you'll be again applying the same set of screens, and not all the cases that you will find all the comparable companies in the database. You can add some comparable companies based on your experience. So the best way to look at it is you go to the client and ask for the list of competitors and see that whether all these companies are featuring in the final set. So that's how you approach. So you need not be bothered much about the litigation, because whether it is 15% or 18% or 10%, as long as the revenue is more than whatever, and let's say if it is more than 50 CR or 100 CR, I'm saying the large companies, large back-end offices will have year-on-year litigation. Okay, so litigation is always there in transfer pricing context for medium and large companies. So Suchin, you want to add on to that?
Just to say that there is a timing difference between the assessment and the documentation. So the documentation is a good reference point, because in any event it will scan the entire database and arrive at a filtered search. It's not to say that only the companies that you finally select are the comparables. You may end up with, if you look for software companies, you may reject some companies, and those may have been accepted by the TPO. So there is, in a way, if you wanted to expand your scheme of examination, you could look to the TPO's assessment order to see what companies he has selected. But to my mind, that is redundant, because anyway, the transfer pricing study as accompanied with the accept reject metrics will already give you the most recent set of companies. So then going into any others, maybe just good to know, but probably not very relevant from a data point of view.
Can I ask a small question? From a valuation perspective, if in the transfer pricing report of the yesteryears, there is an adjustment to the arm's length price, or for that matter, it is so the case in the income tax assessment, do I change my discrete period assumptions and also extrapolate the additional arm's length price adjustment to the revenue or to the EBITDA multiple, EBITDA per se in the structures, and change the valuation despite the fact that cash flow may not flow?
Yeah, I think we have to, I'll take that question in two parts, and I'll address the first part, and Praneeth can add on as well. See, when we determine the transfer price, we are operating on the premise that the transfer price is determined based on the transfer pricing study. The conditions of assessment will continually evolve. And I say that because even when there is an adjustment that is ultimately determined by the tribunal, the company on its own volition may not necessarily accede to that transfer price. That is one. And therefore, the past may not have an indication of the future. Although I must say that if you look at the years 2005 to 2012 or 13, when companies were operating at, back in the day, 2005 to 2009, companies were operating at cost plus, let's say 5, 7, 10%. And a lot of them have automatically, as a result of adjustments happening every year, they have increased their transfer prices to now more respectable numbers like 15%. Therefore, there is already to some extent a conditioning as a result of transfer pricing adjustments that has happened. But of its own accord, because there was an adjustment, wouldn't be reason enough to say that therefore the subsequent years EBITDA margins need to be necessarily changed. And again, the COVID impact is a good example of how a single year could dramatically change things. So, and that would apply to comparables as well. So I think that to my mind, it's a matter of probing deeper to understand the company's approach to transfer pricing and whether and to what extent it intends to litigate. There are companies that will fight to the end and they will win those battles. There will be companies that will give up midway through the process, but it doesn't mean that the company that gives up midway through the process is any less right or wrong than a company that fights to the end.
So even if I'm not fighting to the end, my small question was, should I make the adjustment in my discrete period projections, either in the EBITDA, PAT, because PAT simply because it gets adjusted because of the taxation due to the revised ALP. Should I do that effectively for determination of my subsequent cash flows and therefore reduce my valuations or increase my valuations accordingly? That was my question actually. So should I do that if I'm actually subsequently valuing?
You should understand as to from the company as to where it expects to come out on the litigation, because accordingly it will also make a provision, and to that extent the provision will have an impact on the eventual cash flow, because
Right.
not every company will take its own approach to determining how much of a provision it calls for, and to that extent there will be an adjustment that will be required.
Thank you. Another very small question. While the information between the department and myself is privileged, if, for example, in the other country and I have an access as an auditor to that information, there is an adjustment in the ALP in another country, and I'm certifying things like the MEIS schemes or the SEIS schemes here in India, should I then basically make an adjustment in the price here for taking incentives from the government or not?
So that is that's a slightly more nuanced question on transfer pricing, but I would say that you could regard it as being what is called as operating income, and take it as part of your profit margin for the purpose of transfer pricing. In other words, supposing you are operating at 15% and you got additional MEIS income, you could potentially increase that profit margin from 15% to 18%. But that's on the premise that that you are keeping the benefit of that MEIS. See, what also happens is that we have to be realistic about the principles of economics that will drive behavior of the counterparty. The counterparty will often say that the MEIS resulted from its giving the order to the Indian company, and therefore the Indian company benefited from the MEIS, and therefore the benefit of the MEIS should be passed on to the counterparty, which in other words will mean that India will still keep 15% because it will reduce the this from the cost base. It will reduce the MEIS incentive from the cost base by therefore shifting the benefit of the MEIS to the counterparty. What is probably a more logical approach is to say that it arises both from demand and supply factors, and possibly proportion. I mean, there might be a splitting of the MEIS incentive between the two parties.
Thank you. Thank you.
I had a question. Now, there's a wholly owned subsidiary of a US company, which is providing software development and support services to the US parent company. However, the US parent company business is not software development or support services, but it is probably, you could say it could be like an Uber, which is a completely different business altogether. Now, when I am doing transfer pricing study for the Indian company, will I be comparing it against the software development and technical support service companies, or will I be comparing it against maybe cab hiring companies? And this being the first year of transfer pricing, there is no precedent. So how do we go about it?
So the comparables have to be determined with reference to what is called as the tested party. And we have to look at it with reference to what would this cab hire company do to hire a comparable Indian company to perform the outsourcing function? And when you do that, you're determining a question of what are the realistically available alternatives to the company that is engaging the Indian company. And those realistically available alternatives could be an HCL, could be a Infosys, could be a Happiest Minds. And therefore, the answer is that one has to look at software development companies because that's the function that the foreign company intends to outsource, where it has realistically available comparables on hand.
All right, but in the light of current situation like COVID-19, where the business has been impacted, so would we still compare it against software development companies? Because software development companies have been doing well. However, say cab hiring company, because of the pandemic, has suffered. So, in the light of the situation, would we still would it be right to compare it against software development companies?
Yeah, so what would happen is that you would reasonably expect that the foreign company will in turn, because its fortunes are significantly impacted, its natural instinct would be to renegotiate its contracts with the Indian entity, whether it is a third party or it is a related party. And therefore, it is but natural that the Indian company's profits will shrink because it the same conduct that would have applied to the Indian company would apply to an HCL, to Wipro as well. So therefore, they would also necessarily operate on lower margins. Now, it could well happen that the lower margins could be compensated by higher amount of outsourcing work, which is quite often the tendency that we've seen in this COVID time, that there's been actually accelerated hiring, but at the same time, there has been a lower cost. The answer to that question is that you would still look to comparable companies that are doing software development. You may still look at more nuanced forms of the analysis. You might say, is there a segment of a company like Wipro that caters to the travel sector? And therefore, I should look at the profitability of such segmental analysis. That is possible. Or do I have companies that are software development only catering to hospitality? Then you would look at those kind of companies. But that's not to say that you would not look at software companies.
Okay, so could I say that include? I mean, apart from software development companies, I would also include hospitality sector companies or other companies to make the comparison more realistic.
No, you would look to software companies that are catering to the hospitality sector.
Okay, so it has to be a software to software comparison only.
That's right.
All right, thank you.
I know we have a lot of ground to cover, and we're still 10 minutes left, so we will see where we get to.
Praneeth and Suchint, just a very quick question. So sorry to jump in. So from a relative evaluation perspective or a market approach, the underlying data is as important as the actual valuation process, right? In terms of being the valuation being defendable and accurate and authenticatable as well. So widespread databases that is used for relative valuations include Capital IQ, Bloomberg, and BVR in certain cases. So from a transfer pricing point of view, what are the prescribed or the widely used databases? And the second part of my question is, what metrics do we really extract from the databases to perform such transfer pricing evaluations?
So as far as databases are concerned, I would say that we normally use about 3 of these databases: ACE, TP, Capital Line, and Proves. The department, for example, uses Proves. We typically use ACE, TP, and Capital Line. These are the databases. But as to your question on metrics, we normally use the profit before interest and tax as being the reference point for determining profitability relative to sales or cost.
Fair enough. Thank you so much.
So there are other databases like royalty stat database, which has population of all the licensing arrangements between US listed companies. So we have a slide deck on valuation of intangibles. We'll give an example how a royalty stat database can be used while valuing, suppose, a brand under relief from royalty approach. So in the interest of time, we'll quickly skim through a couple of slides, which we already discussed in earlier slides, and jump onto that slide on valuation of intangibles. Also, I can see few questions in the chat box. We'll address them in the end. Okay. So here in this slide and next slide, what we wanted to say that there are various data points or comparable sets that are used in the relative valuation approach, which is comparable transactions and comparable companies approach. Or else in DCF approach, there are various assumptions or parameters which are derived based on, say, industry or comparable set data points. So in case of comparable transactions, say we use Capital IQ database, we can apply set of filters and directly arrive at a transaction value or enterprise value that was agreed between a target and the bidder for same set of businesses. However, comparable transaction method has its own set of limitations because the those precedent transactions will have a rationale behind entering into the transactions, and there could be control premiums and synergies benefits that could be imbibed into the finally agreed price. So we don't have any more public data points to make reasonably accurate adjustment to those transaction values to arrive at a comparable transaction value. So that's why in most of the cases, though we present the search write-up and comparable transactions, we mention this set of limitations and try to tend to reject or use it as a supplementary analysis to the final value. And in case of comparable companies approach, public comparable companies approach, so it's like you can, as we already discussed in detail, you can start with the TNNM or the transfer pricing report and try to find the final set of comparables. So now in DCF, let's see how the comparability factors or industry data points come into play that can be derived from the transfer pricing context. So how we approach the DCF. So first we do financial modeling. So we try to project the P&L and balance sheet. So in P&L, we project the revenues down to EBITDA. So while projecting each of these line items, so we have 2-3 approaches to it. One is top-down approach, where we have the total addressable market, and we know the market. We based on the market share of the subject asset or company in that we are valuing. So we try to arrive at the revenue figure. Then there is a bottom-up approach where we start with the unit economics. Say we know the total volume of or quantities of particular product that can be sold to X number of customers, and we know the price. So thereby we derive the revenue. There are statistical methods like regression analysis. Based on dependent and independent variable, we try to extrapolate the projections. And the final is the most commonly used approach, which is year-on-year growth approach based on the historical P&L trend of the company, which is value, we tend to project. So now how can we do a sanity check of that? Okay, whatever data points we have projected. So we can either check what are the margins or revenues or year-on-year growth rates that the set of comparable companies are earning, or we can draw a reference to industry. Industry is nothing but set of similar comparable companies operating with a similar business profile. So it is also a larger population of comparable companies. So that is how you can draw a reference or do a sanity check or vet it by comparing these parameters to a comparable companies or industry data points. Then we go to the balance sheet. So in balance sheet, to arrive at the working capital changes, we look at the receivables, payables, and inventories, and then there are fixed assets, and then there are financial transactions or capital structures. So for all these, there are two approaches. Either you use a detailed approach where you have a clear log, say for receivables and payables, you are a clear register of your customers and vendors. You know when I'll pay. Based on that, you can project, or you can take a data point from an industry or comparable set. Say, okay, for software development services, the average credit period is 60 or 90 days. So based on that receivable days, we can calculate receivables. Similarly with payables and inventories. So next comes the fixed assets or capex projections. So either you can take based on management discussions or the detailed projections, or you can do a sanity check by checking what is the capital asset turnover ratio of industry or comparables. Same thing with the debt equity composition. So it could be fixed in terms of absolute, say 50 crore, or it could be fixed in terms of percentages, say 70 equity, 30% debt. So we can check that debt equity mix by seeing what is the debt equity mix for that particular industry or based on a comparable set. Then we go down to valuing projecting the free cash flows. So in the free cash flows, while arriving at the terminal value, so we can approach the terminal value with two methods. One is commonly used Jordan growth model, which is growth discount model, where we use the perpetual growth rate to arrive at the terminal value. So again, that perpetual growth rate, most of the times we assume 3% or 5% or 10%, but it is important to have a backup documentation saying that, okay, the expected growth rate for this industry or similar set of comparables is 3 or 5%. Or you can use economic factors, say GDP is more or less in that range. So that is how you can substantiate that terminal value under a growth Jordan growth approach. Or if you are using a market multiple approach, say EV by EBITDA to arrive at terminal value. Again, multiples are always based on the comparable companies. And then comes the discounting factor, which is important one. So discounting factor, while computing the weighted average cost of capital. So on the debt equity mix, we can take a reference from the comparable or industry. Again, when using CAPM approach for calculating the cost of equity, where we have to use a beta or market risk premium. So either you can use market indices or beta of whole gamut of companies, or you can take the beta of particular industry or set of comparable companies. So these are various places where either you can directly use comparable or industry reference points, or you can just do a sanity check saying that, okay, my assumption based on management discussion and historical projections is this much. Is it more or less close to what industry or comparables are making or not? So there is that this Damodaran Professor Damodaran website, where on yearly basis he presents list of data points by region, by industry, by comparable set, where you can get all these parameters. So you can just see those and do a sanity check. So that is what we want to present in this and next slide. So with that, let's jump on to the most important topic. So before that, I'll present a poll question. If you have any doubts at this juncture, we can take it up.
Yeah, I'm just conscious of time. I know you presented full question, but this is more to Shilpa and Uttam, because I think that we have another maybe 40 minutes of time to run, because uh, if we want to, do justice to the content, I think we will take another 40 minutes more. Now, I do also recognize it's a Saturday morning, so people might have commitments. Do we want to have another session for 45 minutes to an hour some other day, or how would you like us to proceed?
My suggestion is to extend till 10:30, if
Okay.
it is okay for others. My suggestion is to wrap by 10:30.
Yeah, that would be better because there's continuity, no? Otherwise,
That's
repetitive.
true. Yeah, I think we are in a flow. So there are two things. Whoever have commitments, we try to put in a lot of content in the slide deck also. We will be sharing the slide deck at the end of the session. You can go through it independently, and if you have any doubts, me and Suchint will be happy to talk after the session also. And if, as Shilpa said, if it is possible, then we can extend and try to wrap up in another 20-30 minutes.
That will be better, Praneeth. You can go ahead.
All right, that works well.
So I think all of them have answered it correctly. It's the cost approach, because in cost approach, it's based on an assumption that the value of an asset, a value is derived from the underlying asset rather than the ongoing operations. So that is when we use cost approach, and there is very less or no link to any comparability factors in the cost approach. So let us jump on to the next topic, which is the valuation of intangibles. So I'll let Suchin to take up.
So, first and foremost, when we address intangibles, it is very open-ended as to what intangibles are. But suffice to say that intangibles are anything that have value, but at the same time cannot be, let's say, let's call it held in your hand, so to speak. But where it's important to recognize that these are belonging to a company or belonging to a group, and you can ascribe their ownership to a particular entity. And so therefore there are forms of intangibles that are much wider. For example, location specific advantages. These are not regarded as being intangibles because they are factors. They are factors that will determine whether and to what extent a company will, let's say, outsource to India. But by itself, that does not mean that a company that is in India has a intangible advantage of a location specific factor. Having said that, if you think of brand names, then there is arguably a case to say that any company that is performing functions that pertains to the nurturing and the uh, cultivation and the taking to market of a brand, then is playing a role in the development of the intangibles. So intangibles therefore have a very significant role to play, especially if you look back at the second industrial revolution, when there was a lot more focus on machinery and factors of production were a lot more tangible. You would associate the market capitalization of the company to its fixed asset base. Have now it's gone so much of an extreme that the fixed asset base of a company practically is not relevant, especially in companies such as Google and Facebook. And it's all about the intangibles, and these intangibles include assembled workforce, they include the intellectual property, and a lot of it in a way resides literally in the cloud. And so the market capitalization as a proportion of fixed asset is a good representation of how much of the company's value is in fact represented by intangibles. And therefore the part transfer or the whole transfer or the licensing or any forms of alienation or sharing of intangibles will bring in either valuation and or transfer pricing considerations. So if we go to the next slide, we would see that there are three approaches again to determine the value of intangibles. There is the market approach, and the market approach is really about what did comparable transactions result in for the transfer of intangibles. And we can often determine this either in a direct manner or in a derived manner, especially when we know the ratio of intangibles to tangible property. Even an enterprise value is a good indicator of what the valuation of the intangibles has been. But really speaking, here we look to saying, do we have comparable transactions that existed where brands or so intangibles are really largely divided into two parts. There are trade intangibles. Trade intangibles refers to anything to do with intangibles on the production side. And production side does not only mean production of tangible assets, but also intangibles. So anything to do with production side is referred to as trade intangibles, and anything to do with the marketing side is referred to as the marketing intangibles. So brands, for instance, constitute marketing intangibles. Know-how, for instance, constitutes trade intangibles. So you could identify transactions that have truly taken place in the market. One of the examples that comes to mind is, let's say, the Hotmail transaction that was where Microsoft bought Hotmail is a good example of a transaction involving a market approach. Similarly, the transaction involving WhatsApp is another example of the market approach. The income approach refers to a situation where the company hypothesizes that it had to pay a royalty. So it is what in the context of COVID also, we call it as a but for COVID context or a but for COVID impact. If COVID had not struck, what would the company have done? And that scenario is baked into a similar scenario for intangibles, that if I did not have this intangible, what would I have done? I would have had to pay a royalty. How much of a royalty would I have paid over the lifetime of the asset? And that based on a royalty stat analysis, which is a database that gives you royalty rates between uncontrolled companies, you can determine what would have been the hypothesized royalty, and the discounted value of such royalty payments would result in the determination under an income approach. The cost approach, which also often enough otherwise can be substituted by a capitalized cost approach, is to do with very, very nascent intangibles, where the ability to determine what the value of those intangibles is extremely weak, and that's when you would refer to a cost approach. Therefore, mostly or very highly discouraged, but at the same time, it may be relevant when an intangible is extremely in the nascent stage. So think of a pharma intangible like a molecule that's developed, not even gone to phase 1, or has barely entered phase 1, and you transfer it, you may be able to use a cost approach if you cannot reliably determine the cash flows from it. So that's now we then turn over to the next element, which is the concept of hard to value intangibles. And hard to value intangibles is a notion that has been developed by the OECD in the context of transfer of intangibles, where the ability to predict any of their cash flows with any degree of certainty is very low. And therefore, because it's very difficult to predict cash flows, what the revenue authorities have said is that if within a period of 7 years, we determine that there is a variance of 20% between what you projected and what actually resulted, then we will be able to make the adjustment on the basis of actual outcomes rather than projected outcomes. But that is it is up to the taxpayer, therefore, or the valuer to determine and to document as to why there are certain reasons why the ability to project cash flows is either not possible, or that the projections were made on a bona fide basis. And this could well be the case with probabilities being assigned to the outcomes, and that could mean that you may have a range of outcomes possible, and you are operating within that range to say that either those outcomes are within the range or not. But what's important here is, while we may not have often enough cases to do with HTVI, because this applies to very unique situations in the pharma sector, as we are seeing with the vaccine, or it could apply with intangibles such as SaaS products, or what we've seen with social media, Instagram and WhatsApp. Those kind of blowout successes, where you may have an astronomical increase in valuation simply because your user base might spike, and those are referred to as cases where HTVI valuation will apply. But the point to note here is that it is a good reference point for us to say that the tax authorities could come calling if we find that our valuation projections are not well documented, or that we have not gone into looking for comparable companies adequately, and or there is a large variance between ex ante and ex post valuations. And that's the reason why the OECD also gives examples of where the company has not been able to provide adequate explanation, which may be legitimate, but it doesn't provide adequate explanation as to why its basis of projections were different from the outcomes, in which case those outcomes could be substituted for the projections. So that's an important aspect that got brought into OECD regulations about 5 years ago.
Thanks, Suchint. So I'll present the next poll questions. Meanwhile, if you have any questions around intangibles valuation, then we can take it up.
I think what's important in intangibles valuation is that we are seeing a good deal of, as we spoke about, base erosion and profit shifting. And while this is, there are a lot of measures that different governments across the world are taking to contain such measures. But at the same time, it should be recognized that there is a high propensity to transfer intangibles into low tax jurisdictions and realize royalties on the back of such jurisdictions, which is why the concept of base erosion, profit shifting is something that is quite prevalent because of the rise of intangibles.
Thanks, Suchin. So, in case of purchase price allocations, so earlier in those days, the entire sale consideration less net asset value is to attribute it to goodwill. So now the standards require you to attribute these to various set of intangibles, say customer relations or brand value or your network. So it will be pertinent to understand or have a knowledge on how to value intangibles under various approaches. So I'll be ending this poll. Let's see the results. I think it's pretty straightforward. Marketable securities is not an intangible asset. So let's move to the next slide. So in this slide, we have presented a real case study, which is in context of a valuation report. Few data points in valuation report were disputed during the course of proceedings, and the tribunal has held what is more reasonable on those data points. So let me take you through the facts and points of dispute in this case study. So it's Technip Italy versus DCIT. Okay. So there were two non-resident related parties, one in Italy and one in France, which were transferring the shares. So Technip Italy was the holding company of Technip India, which is again another related party. So the all entire shareholding, which is held by Technip Italy, was transferred to Technip France. So now the transaction here is transfer of shares. Okay. So for this transfer of shares, which is an international transaction between two related parties or non-resident associated enterprises, we have to determine the arm's length price for this. So the appellant, which is Technip Italy, has relied on the valuation report, which has used discounted cash flow approach to arrive at the sale consideration. Okay. So why the tax authorities or the revenue has disputed? Because these shares of Indian companies or capital asset in India, and pursuant to this transfer, there is capital gain arising in India, which is offered to tax. Okay. So what, in our experience, that the transfer pricing officers or revenue try to do is they tweak certain assumptions or the data points in valuation in such a way that the sale consideration will increase or the capital gains that are offered to tax will increase. So that's why it will be very important to have a backup documentation in place for the values that we have arrived in the valuation report. So that could be used, say, 2 or 3 years down the line when the assessments or litigation happens. So in this, the points of dispute were lastly 3 points. One is on the illiquidity discount. So since this Technip India was a private company and the shares were not liquid, the valuer had given a liquidity discount, which the transfer pricing officer did not accept. So that is the first dispute. Second dispute is under DCF valuation, while using the market risk premium under CAPM approach, the valuer has used the index performance right from the inception. So they've used Sensex index performance, the average return on it, right from the inception. It's 1979. Whereas the transfer pricing officer has used it since the date of incorporation of the company, which is, I think, 1988, 1998. Okay, so that's the second dispute. So the valuer has arrived at around 8%, whereas transfer pricing officer has arrived at market risk premium of 5%. So the second dispute was that. Third dispute is transfer pricing officer has, based on some ad hoc value, added a goodwill to the final sale consideration or the value or enterprise value, which was arrived under DCF. So there was a value under DCF. On top of it, he arrived at he added a goodwill value, thereby bloating the sale consideration. So these were the 3 points of dispute. So let's see what tribunal has observed or ruled for all these 3 points. The first thing is illiquidity discount. It was pretty straightforward. Tribunal said that yeah, to give a rebate for this illiquidity discount because the shares of Indian company, which was a subject asset that is transferred, are not liquid in the open market. So that's on liquidity discount. Second thing is the market risk premium. So on the market risk premium, while they have uphold the approach that is used by valuers, they have not uphold the process that is used, but they have drawn reference to an industry or comparable data point. So interestingly, they have made reference to this the website of Professor Damodaran and said that so he has used they do publish all these parameters in their website, and the market risk premium that was published based on industry or comparable set was around 9 to 8%. So the valuers the market risk premium was percentage was around more or less the same, which is 8 to 9%. So thereby they said that yeah, since both are close, they said whatever valuer has used is correct. The third thing was on the goodwill. Okay. So on the goodwill, the ITED observed that once you use a DCF approach, the final enterprise value subsumes the current and projected value both from tangible and intangible assets. You can't add additional value of intangible in terms of goodwill on top of it and load the sale consideration. So that is what they've ruled. So while observing that, they have also made some reference to ICA guidelines on this valuation. So all that we wanted to say in this slide is there are many litigated cases like this case where the parameters. So most of the times, what based on our experience, what we see is the dispute could be based on the valuation method that is used. Okay, say the valuation report that we have relied on, the valuer could have used net asset value, whereas TPO would say that no, we have to use DCF. So it will be important to have all the methods evaluated by giving limitations or advantages of using each of the methods so that it could be defended during litigation. Second thing is on the assumptions or data points that are used. Okay, say if the DCF value is used, to our experience, what we have seen is dispute the perpetual growth rate. Okay, while arriving at the terminal value. So if you use 3%, they aggressively use say 7.5% or 10%. The other thing is the discounting factor, like we have seen in the present case, the market risk premium or the betas. So they try to use aggressive assumptions in such a way that they increase the sale consideration. So these all these data points can differ from valuer to valuer based on their intuition and perspectives. So what is important is to have documentation in place. Say okay, if you use the growth rate or a discounting factor or market indices of whatever percent, you can do a sanity check or corroborate or supplement with industry or the comparable say data point so that that can be used to defend at the time of litigation. So I'll let Suchin to add on some more based on his experience. Suchin, can you hear?
Yes. So I think I lost connectivity for a bit, but I wanted to just take up a question that Abraham had earlier on the fact that you could have a US company and you could have an Indian company, and then what should you value? So let's take a situation where you have a Indian company that owns a US company. Normally, what would then happen is you would expect that the value of the US company will be contained in the Indian company's valuation, which is reasonable because on a consolidated basis. But be that as it may, when you have the situation, the transfer pricing construct is an important determinant in the valuation of each of the businesses. So if, for instance, you had an Indian company that owned a US business and the US business was given a cost plus return, then it would be predicted with certainty as to what the US enterprise value would be based on the estimated cash flows. And the Indian business would then be valued standalone as if it was a, let's say, an entrepreneur, and therefore would not be based on the fact that comparable companies have a cost plus 15% markup in India. So we have to be cognizant of the business model, depending on who is controlling whom and who is determining the transfer pricing arrangement of the respective tested party, because one entity is typically going to be the less entrepreneurial entity or the risk-free entity, and that entity's valuation can be determined with more certainty than it would be with respect to, let's say, the entrepreneurial entity, which obviously carries greater risk and therefore is subject to greater uncertainty. Uh, with that, I'll turn to the last slide, which is to do with opportunities that valuers would have in the transfer pricing realm. Now, we have to recognize that the transfer pricing or the applicability of transfer pricing comes up in three situations. One is when there is a planning exercise that is done in order to set the transfer price. And that could well be the case where you say that should I operate at cost plus 10, 15, 20, and why? Or if I was a contract manufacturer, then should I be compensated on a piece rate basis, or should I be compensated for all my costs, including fixed costs, and so on. So that is to do with the price planning or price setting exercise. The second is when you deal with the compliance, which happens on an annual basis. And in the compliance phase, you're essentially writing up documentation. And the documentation is what will stand in good stead for the purpose of the audits. And the third is when you have a litigation, which actually comes on the back of documentation, because the case gets picked up, the transfer pricing officer finds that the valuation, or to be precise, the transfer price is not at arm's length according to comparability analysis that the transfer pricing authority undertakes, and therefore challenges the valuation, and therefore it goes into an appeal proceeding, and it won't go up into tribunal. So in that situation also, you might have to build additional scenarios to say that what if the transfer price was different, or what if certain comparables were included or excluded. So these are use cases for transfer pricing applicability. Then we come to what are the kind of transactions that would involve transfer pricing and where valuation has a role to play. So clearly, all kinds of financial instruments and the transfers of these instruments, issue, transfer, or liquidation of these instruments will call for a valuation. And therefore, we've spoken about issues and sale and buyback. In the context of intangibles and tangible assets, there will be, again, a requirement for valuation. Typically, if it's a licensing event, if it is a purchase or sale of intangible property, tangibles are relatively easy to value, but intangibles will invariably have elements of what's the useful life, what's the decay factor, and how do I determine cash flows based on useful life. So there will be, again, an aspect of evaluation that will come into play. The third is when there are mergers and acquisition transactions, when we are dealing with itemized sales, slump sales, maybe in the context of a merger or a demerger, where there will be valuation arising between related parties. Even if there is no tax impact, there may be tax neutral transactions, but nevertheless, there will be elements of valuation. There could also happen to be cross-border mergers, in which case, again, valuation will play a role. Then there are specific transactions. So think of what is known as a cost contribution arrangement. So two parties decide that they will develop an intangible. So think of pharmaceutical companies that are increasingly doing so. So we had the Moderna vaccine, we had AstraZeneca partnering, we had Pfizer and the the German company partnering. So these are cases where two companies come together and they decide that they will pool their resources in order to develop an intangible, and they will exploit that intangible together. And in that situation, again, you would have the applicability of transfer pricing to determine how should the economic benefits that flow from such an arrangement be divided among the participants. And this will involve what is called as reasonably anticipated benefit determination, which will be essentially projected cash flows arising from the two parties' contributions, and their contributions therefore will be measured up against what their anticipated benefits will be, and to that extent they will effectively split out the costs that they will contribute for the purpose on an ongoing basis. Same thing would apply to, let's say, projections that may apply in the context of where you have losses, for instance, and you have to defend the loss because the company was in a startup stage. What would be the projected cash flows of the company in future years when there is a reported profit? That would again be, and to discount that to today and to say that therefore on a 5-year projection basis, we would effectively be transacting at arm's length. And then there could be economic adjustments, which is not very common, but when you have some regional comparables, you may have to make some economic adjustments on account of currency risk, on account of market risk, which is again where there is the possibility of applying valuation techniques. But the gist is that the documentation around transfer pricing forms a very strong bedrock around which the framework for equivalent documentation or equivalent processes for valuation could be constructed, especially to demonstrate that in the process of arriving at whatever method, we followed a most appropriate method rule. We eliminated the respective methods that were not considered, and why, in arriving at the appropriate method or methods. And we could well use more than one method in order to determine the range around which the value would fall. So these are certain systematic approaches that are applicable in the transfer pricing construct and have evolved over the years through jurisprudence and through legislation that could find useful application in the valuation realm. So with that, we come to the end of our presentation, and we'll be happy to take any questions. We will have a few minutes. I think we're on the top of the hour, so I think we are pretty much done from our side.
I had a kind of specific, this example of maybe a non-resident company transferring its Indian subsidiaries shares to another non-resident company being its own associate. So the moment they are associates and it is an Indian company's shares that is being transacted, there's a requirement to determine the arm's length price. So is there transfer pricing related things getting triggered here, or it's just about section 9 applying, and specifically the sections that would apply in this case?
You take that, Praneeth?
Sorry?
You take it up, Suchint. I'll add on to it if there is anything.
So clearly, in this case, transfer pricing would apply because we are dealing with the shares of a foreign company that are held by the Indian company, and the transfer of the shares involves the shares of a property that is situated in India, and therefore the transfer pricing provisions will be more because the gain arises to the Indian entity on alienation of the shares. When we do this analysis, we will have to therefore value the overseas entity and determine whether an arm's length price has been paid for the shares that are transferred by the by the Indian associated enterprise that holds the foreign company to another non-resident transferee.
Yeah, from the transfer pricing angle, the valuation would be on arm's length basis, whereas under the domestic tax laws, which would require valuation under section 56(2)10 as well as under section 50 CA, the valuation would be required under the adjusted book value method. So we just have to be mindful of both the methods and accordingly proceed.
Yeah, the methods from valuer's perspective, it would be more of just regulatory related sections like 56 to 10 is related to 11 UA. So there is a specific way of computing the value of the price of the a particular transfer. So this transfer pricing methods as such would not come into application, right?
They would. You see, the only point is that Uttam is making is that there is a certain checkpoint, which is let's say a threshold value that the regulatory framework calls for. But that's not to say that that's the arm's length price, because let's say that just for argument's sake, the NAV came out to be, for example, 100, but under a DCF, the answer came out to be, let's say, 175. And under a comparable transaction method, the answer came out to be 215. Then the arm's length range would likely be 175 to 215 and not, for instance, 100.
Okay.
Sindhu, in your case, the transfer pricing regulations would kick in because this is a transaction between related parties. Had it been a transaction between unrelated parties, then section 56(2)10 and 50 CA would suffice. Only because this is a transaction between related parties, transfer pricing would also kick in, and adjusted book value method might not be the right method to defend ourselves.
Yeah. Okay. Thank you.
I just have a question. So there's a lot that's going on with the OECD and the digital economy. The pillar 1 and pillar 2, papers have come out, and there's a lot of work on that. Intangibles arising from the digital economy, will they be treated any differently from what we've been seeing in the brick and mortar structures? And do you see a different approach being adopted, and do you see different methods being adopted by the valuers for valuing intangibles coming, arising from the digital economy?
So two parts to that question. One is, what is the definition of intangibles and whether that will change in the light of the digital economy? I think the biggest question is that of data, whether it's an intangible, particularly in the light of data localization rules. And I think that the jury is still out on that, because hypothetically you could have algorithms that are always owned by the foreign entity, but data under localization laws would be, in which case it may not be possible to transfer data. Even hypothetically, it may not be possible to transfer data to a related party by virtue of operation of law. So that is about whether and to what extent intangibles may change on account of the digital economy. As to valuation methods, I think that increasingly we will continue to see transactions that will happen in the digital space that would be reference comparable points. You see, comparable reference points could exist by virtue of share prices that represent the value of companies, and these could be measured against, let's say, their revenues, and therefore you could get a revenue multiple. Or you could have valuation cases in terms of acquisition prices, like what happened with, let's say, the Geo transaction, in which a number of companies invested at different points with different values. And you could almost get to a answer as to what was the let's say, consideration that was acquired as a result of the investment. So I think that in terms of valuation methods, I think at the basic level, there shouldn't be a change, but there is likely to be a change in relation to the changing nature of intangibles that may or may not be owned by enterprises.
Thank you, Suchint.
So there are a couple of questions in the chat box. One is if there is a transfer of shares of Indian entity which is not holding any tangible assets, whether in that case there would be any transfer pricing implication. So transfer pricing implications will be triggered the moment when there is a transaction between two related parties. Okay, whether the transaction has substance in it or not is a secondary issue. Once it is qualified as an international transaction, the transfer pricing provisions will apply, and then they have to substantiate whether the transfer price is at arm's length or not. So in that case, we have to still value that company even though it doesn't have intangible. So we might arrive at a nominal value, but there should be some transfer pricing methods or valuation methods used to arrive at that value. That was one question. Other question I think was whether in case of cost plus entities where we don't have transfer pricing report in place, can we rely on the safe harbor margins? Okay. So on that, this safe harbor, the margins or markups or rates that are prescribed under safe harbor rules in the IT Act are not per se arm's length prices, okay, or fair market values, okay. It's only a reference point, and those are not applicable for all the transactions. There are various thresholds. Say for IT, ITS, back offices, it's applicable only for small enterprises. So the rationale or the reasoning for implementing safe harbor rules was to avoid litigation. Okay, for and to allow these small and medium enterprises to adopt the safe harbor margins and avoid that litigation. So a reference can be made, or we can use the margins which are prescribed under safe harbor, but those are slightly higher than what an arm's length price could be, because revenue would not uh, want the taxpayers to adopt a price which is less than what's arm's length price, because it will be a hit to their uh, account. Suchin, you want to add on to that?
No, I think the only point to say is that not all companies will be affected by the safe harbor rules, because it's also to do with the nature of their transaction, the volume of their turnover, whether they qualify for those activities. So therefore, safe harbor is a reference point, but may not, but one has to use that with discretion and judgment.
Thanks, Suchin. I think Shilpa and Uttam, with that we can close our presentation. If there are any other questions, we'll be happy to address. So we'll be sharing this slide deck and our coordinates after this session. You can reach out to us.
Yeah, we'll also send you this publication that deals with the regression analysis, quarterly data trends, and adjustments to costs.
Thanks, Suchint. Can we conclude, Shilpaji, with the formal vote of thanks?
Yes, I request Mr. Subraidu to offer a formal vote of thanks to the speakers.
Thanks, Suchint and Praneeth. Actually, this topic of linking together transfer pricing and valuation, so far most of us were kind of keeping them in two different buckets. Transfer pricing is a separate bucket and valuation is a separate bucket. And particularly those of us who have come from the corporate job side thought we had actually kind of relegated transfer pricing to some kind of a back burner, and valuation was the new thing. And so this topic itself, the moment I saw that, hey, this seems to be linking an old with a new regime, and what is this? Is instantly something that aroused curiosity, and definitely the session was pretty much worth it. once the separating, the mental separating line was lifted and we started comparing both, particularly when Suchint mentioned about the overlapping circles, right? So that was pretty useful, and we could compare, many of us, I'm sure, for the first time, were comparing the transfer pricing regime with the valuation regime and realized that there are a lot of commonalities. And definitely the idea of relying or even asking for the transfer pricing documentation when we are undertaking a valuation assignment was something new, and there's suddenly like a new idea that has popped up, and something that we had ignored all along. And this will definitely be a very useful source of information that any valuer can rely on when he is conducting a valuation assignment, particularly when it comes to back offices of US office companies, or even US subsidiaries of Indian companies. So this idea is something that was a new idea that has popped up, which somehow for some reason had kind of, we are all in our minds are treating as two separate buckets, right? And then definitely the provisions and the commonalities and the definitions that you walked us through. This session has been a very enlightening session from that point of view. And definitely the last slide that Suchint you showed about the, how the relevance of valuation while undertaking transfer pricing assignments and vice versa, new opportunities for valuers. That again was a revelation to a lot of us. And I think this session for most of us who are in that mindset is only the a beginning of, a new era where, we would kind of open both eyes. Earlier it was like, when you're doing transfer pricing, you had kept the valuation eye closed and vice versa. So now it has kind of awakened us to the fact that, they are two interdependent and related things. And the initial concept that you showed that, when is TP relevant and when is valuation, and what is the difference between price under transfer pricing and value under valuation regime. Extremely useful sessions and very useful slide deck. Please do share the slide deck with us, and at least I found this session extremely useful. I was thinking that transfer pricing is something that I've crossed a bridge and perhaps I might never have to revisit it again. So this kind of reopens that chapter for us, and also highlights the relevance of that to us once again. I think that from that perspective, this PPT and your session, then the question and answers that people are asking are extremely useful. I found that slide upon the transfer of shares from Italian company to French company of an Indian company. That is also very useful. In case when we come across any such valuation assignment, this alerts us to the fact that there is an additional set of rules and additional framework that also needs to be considered by us. Extremely useful. I'm sure this was very useful to every one of us in this, except I think maybe Uttam Padiwal, who is a master of taxation in both regimes. And so for others who are not already masters of taxation, very useful. Thank you very much. Look forward to receiving your slide deck and your newsletters also, as you mentioned. Please do keep sharing those newsletters. We'll find them also extremely useful. Thank you, Bangalore Valuers Association, and all the office bearers. I think we are seeing BVA going from strength to strength. The emails that we're receiving, the registration process and everything, we have moved several steps ahead in formalizing our informal association that we started, I think, about several months ago. Nice to see BVA moving ahead in this. Thank you all.
Thank you very much.
Thanks, Suchint. Thanks, Praneeth. Thanks, Ubraido, for that.
Yeah, thank you.
Thanks to all.
The
Thank you.
feedback,
Thank you,
the
Praneeth.
feedback forms has been circulated. Request all to give your feedback. It will help us to take your suggestions and go ahead.